Good morning. Thank you for joining us today. I would like to welcome you here today to today's webinar called Deadline for the Healthcare Tax Credit is Here. I am Renee McLemore. I am the Vice President of Marketing and Sales at Claremont Insurance Services, and I will be moderating today's webinar. Let me begin with a few housekeeping tips. All participant phone lines have been muted. If you would like to ask a question, look for the question dialog box in your GoToWebinar control panel. You may submit a question there at any time. If you prefer to ask a live question, you will need to click the button in the control panel to raise your hand. You may receive an audio pin to enable your phone line, and you will need to enter that code. When we complete the presentation and begin the Q&A session, I will unmute your line and call on you by first name. If you have any technical difficulties during the webinar, you can contact GoToWebinar Technical Support at 855-352-9003. This is my first time using GoToWebinar software, so please bear with me. I'm still mastering all the bells and whistles that come with hosting and facilitating a live Q&A. So we look forward to a lively discussion. Now, without further ado, I want to introduce today's speaker. Ken Rotolo is our Chief Operating Officer at Claremont Insurance Services, and he will be leading the webinar presentation today. Ken?
Thank you very much, Renee, and thank you all for attending this morning. We appreciate your patience as we worked out a couple of technical glitches, which hopefully there won't be any more today. Again, I want to thank you for attending, and we have a very interesting topic today. We're going to keep it short and sweet for you, try to make this as impactful as possible and informational as possible. And the topic today is about the small business healthcare tax credit, particularly about deadlines that are coming up that you and your clients and prospects should know about so that you can take advantage of the tax credit. So for today's agenda, we'll quickly cover some basics about the tax credit to make sure that everybody is on the same level of understanding with regard to some of the basic facts. Then we'll talk about some of the timing issues, give some examples that should be helpful to you, and then talk about how Claremont can assist. Following that, we'll do a Q&A, as Renee mentioned, and during the course of the webinar, feel free to chat, use the chat feature to type in your questions, and then of course at the end of the presentation, as Renee mentioned, we'll open it up for questions via the phone if you prefer to ask your questions that way. We do have the webinar content scheduled for 30 minutes, and then we've got the webinar room, so to speak, for about an hour. So we're happy to take questions beyond the 30 minutes for those who can stay. I want to draw your attention just to the little blurb at the bottom. As with so much of the Affordable Care Act, there is legal and tax implications and complexities that go along with many of the provisions of the Affordable Care Act. And we're a general agency in California. We're not tax attorneys. We're not CPAs. So we've gotten ourselves up to speed pretty well on a lot of these provisions. But for final legal tax advice, we always recommend that you or your clients talk with their tax and legal advisors. And with that, we'll move right in. So let's talk about some of the tax credit basics. Tax credits in and of themselves are very valuable. They're a dollar-for-dollar reduction of the taxes owed by the business. And they can be very significant. For the tax credit that we're talking about today, up to 50% of the premiums paid by the employer for the employee's coverage for taxable businesses can apply towards the credit. And then for tax-exempt organizations or nonprofits, up to 35% can be applied towards the tax credit. This can actually swing the pendulum to the point where it makes coverage affordable for small employers. And we've done analyses for probably close to 100 different companies now, estimating the tax credit. And the credits range all the way from those who don't qualify to those who qualify for the full 50% or 35% if they're tax exempt. And we have had companies who have been able to offer coverage because of the tax credit savings. Another interesting fact about the tax credit is, like any other general tax credit, is that it can be carried forward up to 20 years. So if the employer earns a tax credit in year one that is greater than they're able to take, in other words, it's more than the taxes that they owe, they can bank that tax credit, the remainder of it, and use it in future years. Let's take you through a little example here so you have an understanding of how the tax credit works. We'll make a few assumptions about a business. Let's assume that the business pays $20,000 towards their employees' healthcare premiums. And let's say that they qualify for the 50%, the maximum amount of tax credit possible, which means that they would qualify for a tax credit of $10,000. And let's make a final assumption that before tax profit is $40,000. So after they take their revenue and expenses all together, they end up with $40,000 in profit. So what does it look like? The column on the left assumes the business has no tax credit. They make the profit of $40,000. Let's say that they're in a 20% tax bracket, so their tax will be $8,000. They're not taking a credit, and so therefore the revised tax after credit will still be the same, $8,000. There's no savings associated with the tax credit, obviously, because they're not taking it. Now, on the column on the right, let's assume that the business has a tax credit, has the same profit, $40,000. However, because they're going to be taking the tax credit of $10,000, what that means is that healthcare expenses reduced by the amount of the tax credit. So where they had profit of $40,000 before, since their healthcare expense was reduced by the amount of the tax credit, which is $10,000, you add that back in, and so their profit is $50,000. The tax at 20% on $50,000 is $10,000, and the tax credit, as mentioned before, is $10,000. So their revised tax is zero after the credit, saving them $8,000 in taxes, the dollar for dollar write-off of the taxes that they owe. If their total healthcare premium paid on behalf of employees was $20,000, then the $8,000 represents a 40% savings. So it's like a 40% reduction in their healthcare costs. And that tax credit accrues to the employer, and it's filed for at the time that they file their taxes. Okay, so how does an employer qualify for the tax credit? Employer needs to have fewer than 25 full-time equivalent employees, and for today we'll just refer to those as FTEs. And they must have an average wage of less than $50,000. Finally, they must purchase coverage through Covered California's Small Business Health Options Program, otherwise known as SHOP. And SHOP provides a wide array of plan options, metallic tiers for employers and employees to choose from, and it's a statewide offering. Important thing to know about the tax credit is that it works on a sliding scale. And the authors of the ACA wanted to encourage business to continue to offer or to begin to offer employer-sponsored coverage. And they particularly wanted to encourage small businesses to offer that coverage. So there's a kind of a sweet spot, which we're calling the maximum credit area here in this chart, that ranges from 1 to 10 full-time equivalent employees and up to $25,000 in average wages. That's the range in which an employer is going to qualify for the maximum credit. Again, a taxable business would qualify for 50%, and a tax-exempt business would qualify for 35%. As you begin to move on out in terms of employee count, or move on up in terms of employee count and average wage, the credit starts to phase out. So the closer you are to the maximum credit area, the larger your credit will be, and then it phases out as you move on up. And if I was technically proficient enough, I would draw a dotted line somewhere around $40,000 or $45,000, and then also somewhere around 20 employees. Basically, what we're finding is that if you're above 20 employees, around $40,000, $45,000, the credit has phased out to the point where it's typically not economically justifiable. There are some costs incurred with filing for the credit. For example, the tax advisor needs to do some analysis and file the forms on the employer's behalf. We estimate those costs are anywhere from $300 to $500. And generally, we're finding that the credit, once employers get into the 20 to 25 employee range, or the $45,000 range of average wages, it just doesn't make sense economically to pursue. But below that, we have numerous companies that we've done analysis for where it did make sense for them to pursue the tax credit. Okay, so the title of this webinar invitation was about deadlines are here. And as with most things, timing is everything with regard to qualifying for the 2014 and 2015 tax years. So if an employer wants to qualify for the tax credit in the 2014 tax year, they needed to have purchased SHOP on or before their 2014 renewal to take advantage of what's known as a transition rule. And the transition rule will allow them to count all of the premium paid for their employees' coverage since the beginning of the year, even if it was not on a SHOP carrier, as long as they migrate into a SHOP plan by the time of their renewal in 2014. And with so many groups renewing in December of 2014, we estimate 50 to 75% of the small group market is renewing in December of 2014. There's a tremendous opportunity to present the tax credit as something that an employer should look at for December. Now, the important deadline is that applications need to be put into SHOP by November 21st for coverage to begin effective December 1. We're a SHOP general agency. We're one of the contracted general agencies with SHOP and can certainly assist you in that process. We've written numerous groups since January of this year and be happy to help you with that. So again, to qualify for the 2014 tax year using the transition rule, where they can use all premium paid during the year, they need to be into SHOP coverage starting in December if their renewal was in December or is in December. What about 2015? The deadline to qualify for 2015 tax credit, it varies depending on what the group wants to do. If the group wants to maximize the amount of the credit, and assuming they qualify in all other areas, they want to move into a SHOP plan starting in January of 2015. That way they'll be able to use the entire year's premium when calculating the credit. And in order to do that, the deadline for SHOP January applications is December 24th. So we wanted to make you aware of that deadline. Now, outside of the crazy renewal period that we've got coming up here in December, January is typically the largest sales month in the small group market. And so we expect quite a few sales to occur for January. And one thing you may want to tell your clients and prospects is that if they look like a good fit for the tax credit, they may want to move into SHOP coverage starting in January. If they don't, however, if they move into SHOP coverage beyond January, some point during the year, the tax credit is prorated. So when I say prorated, I mean the amount of premium that's used to calculate the credit is based on how many months of premium they've paid into a SHOP plan. Let's take a look at a few examples. How does this work? So for the 2014 tax year, we're going to assume that in these examples that a group meets all of the other qualifications necessary to qualify for the tax credit. Let's say this group has coverage with Anthem and their renewal is in December, and they go ahead and purchase SHOP coverage at their renewal in December. As mentioned, they would qualify for the tax credit and they can apply the full year's premium that they paid, even the premium they paid into the Anthem plan, towards that tax credit. Second example, let's assume they had coverage in Anthem, but their renewal was in June, and they decided at that time to stay with Anthem, and they did not make a change in 2014 at all from carriers. They are not qualified for the tax credit in 2014. However, they could qualify for 2015 by moving into SHOP plans as early as January 2015, but certainly at any time during 2015, It's just that the amount of credit would get prorated based on the percentage of time they spent in SHOP plans during 2015. Taking a look at examples for the 2015 tax year, let's say that Anthem group renewed in June of 2014 and they switch to SHOP coverage effective January 2015. They would certainly qualify for the credit, and they would be able to use the full year's premium paid, assuming they stayed in the SHOP plan for the full year of 2015. Second example, assuming they renewed with Anthem in June of 2014 and then switched at their next renewal in June of 2015, they would be able to take the tax credit, but only for the partial year, using the premium paid from June through December of 2015. And likewise, if you have a new group who's purchasing coverage for the first time, and let's say they purchased that coverage in March of 2015, and at that time they purchased SHOP coverage, they'd be able to apply all of the premium paid from March through December of 2015 towards the tax credit. Okay, so to recap on the timing, deadlines are near. Applications due on November 21st for December effective dates and on December 24th for January effective dates. We thought it might be helpful to give you some ideas as to how to target clients and prospects of the potential prospects for the tax credit. And some questions you might want to ask or things you could consider are, obviously, do they meet the general requirements with regard to employee count and average wage? Do they have a December renewal? If not, if they have a 2015 tax year renewal, are they open to migrating to SHOP early in the year? Have they taken the tax credit before? It's possible that clients may have taken the tax credit in 2013 and don't know or don't realize that they need to move into a SHOP plan in 2014 in order to take advantage of the tax credit in 2014. There are groups who have purchased coverage directly with Kaiser and without the benefit of a broker or an agent. Those groups may not have even heard about the tax credit. They have no one advising them. They might be possible prospects to consider discussing the tax credit with. And finally, if a group has a broker who's not Covered California certified, unless you're certified with Covered California as an agent, you cannot place SHOP coverage. So if a group has a uncertified agent, so to speak, that agent may not even be telling them about the tax credit because they cannot place the business with SHOP. Those might be prospecting opportunities for you. Okay, so some good information here. Told you a little bit about the basics, the deadlines, how to find groups or your clients that may be qualified for SHOP. But you're not out on your own on this. We've developed a pretty comprehensive solution that can help you take the steps necessary to assess whether and what the size of the tax credit that your client or prospect may be qualified for, and to give you basic knowledge and your client basic knowledge about the tax credit. It's called CLAREMONT's Tax Credit Solution, and the bright green arrow here is pointing to a button on our homepage where you can click and then download our tax credit solution. And I'll take you through some of what that includes. First, you can learn about the tax credit as a broker. We've created a guide, pretty comprehensive guide for brokers and agents that tells you about the tax credit, dives into a little bit more detail, lets you get up to speed on it so you can feel comfortable talking to your client about it. The second is we've created a guide to the tax credit and also to SHOP that talks about the details of the tax credit and also about pros and cons. Actually, there aren't many cons, but the pros of SHOP, the features and benefits of SHOP, and the plans available. This we've made in Word format, and we've made it customizable for you, so you can apply your logo, you can add your contact information to it, and it's something that you could then distribute to clients and prospects. We know that the next step in the process is going to be to estimate the amount of tax credit that's possible. And obviously, a business owner is going to say, okay, this is great, so how much would I qualify for? We've put together a couple of pieces of a couple of services that we think you'll find helpful. One is a worksheet that allows you to gather the data that's needed to create an estimate. Basic payroll data that's needed, and it allows you to gather that data on a worksheet, basically a spreadsheet, send that on into us, and then we'll produce an estimate for you. And we can customize that estimate for you as well. We can put your logo on it, your contact information, and that would be something that would be suitable then to go back and show your client, to show them how much of a tax credit they might qualify for, and then indeed they can then discuss that with their tax advisor to determine whether it makes sense for them to move forward. If your client or prospect does not have a tax advisor who's familiar with the tax credit, we've developed relationships with a couple of very professional CPAs, and they would work with us on a referral basis. We'd be happy to refer you to them if you find yourself or your client needs that resource. Once your client makes a decision to pursue the tax credit, the next thing is to identify shop plans and coverage options that work for them. And we have a full service team here at Claremont that can help you quote and prepare proposals for your clients, help you with the application process, determine eligibility for shop coverage, make sure that everyone gets enrolled, and finally provide support once coverage is in place. And then finally, the last thing you want to do is obviously make sure that you apply for coverage for your client on behalf of your client in terms of before the coverage deadlines are expired, and we can help you do that. We have a great team, very professional, lots of experience in the industry, and we've got almost a full year of shop coverage under our belt at this point. So we're very comfortable and experienced working with the shop and the folks who run the program there. Okay, just a quick recap on who Claremont is in case you're not familiar with us. We're a general agency. We're based in the San Francisco Bay Area, and we focus in the group benefits market. Our mission, pretty much our sole 100% focus, is to help you as a broker or an agent sell your services and then serve your clients once you've made the sale. And we do that in a number of ways. We provide a number of different services. One is what we call market intelligence and reform and regulatory knowledge. Those are two areas we would consider this webinar as market intelligence and reform and regulatory knowledge. Another market intelligence piece on our website, if you go to the market intelligence area, you can download what's called our top 20 report. And we have pulled together the top 20 lowest cost plans in the small group market in California. One report for each region. So any rating region that you're interested in, you can go and download the top 20 for that rating region. It gives you some insight into what are the most price competitive plans in those regions. We have product insights as well. We're very knowledgeable on the carriers that we represent, and we've got some logos at the bottom of the screen here to show you who those carriers are. Our sales and service team, very experienced and really understand all of the benefits that are offered by the carriers that we represent. Finally, we provide back office support. So when you need help with pulling an application together, making sure the documentation is complete, submitting it to the carrier, making sure it goes through the application process with the carrier smoothly, preparing proposals, getting out enrollment kits and so on. Those are services that we do every day for clients, and happy to do that as well for you. We do these at no cost to brokers and agents. We are working on behalf of the carrier, but for you. And we have 20 years experience doing this. We've been in business for quite some time and know this market very well. So we'd like to put together thoughtful, comprehensive services such as this tax credit solution that I've been talking about today. Wanted to give you a few links to some helpful reference. The IRS has a great little mini website dedicated to the healthcare tax credit. I provided a link here. And I'm not sure if Renee mentioned, but we will make this presentation available on our website within the next day. So you'll be able to have this at your side, and you'll be able to click on these links to go to these pages. The Q&A particularly, and the instructions for Form 8941, that's the form you file to claim the tax credit. Those are two very good resources for you and your clients and your client's tax advisor. Small Business Majority put out a great report on the tax credit for California employers. Recommend that. It's good reading. And then the National Council of Nonprofit has put together some good resources for tax-exempt organizations and how the tax credit applies to them. There are a couple of little twists with regard to that, and they put together a very nice resource there. So to summarize, we see potential significant savings through the tax credit for those employers that qualify. We have a huge opportunity here in December and January, and those deadlines for getting groups onto SHOP plans are in late November and late December. And this is a great chance to develop prospects and to serve your clients by making them aware of the tax credit and how it might potentially benefit them. We strongly encourage you to have a look at the materials that we've provided in the tax credit solution, and then don't hesitate to contact us. Feel free to give us a call. If you have a sales rep already, contact them. We can get you started. We can certainly do the analysis and prepare the estimates for you that lets you know how much credit your client might be eligible for, and I'm happy to do that for you. So feel free to use us as a resource. Now we've reached the Q&A portion of the presentation, and I think we have some questions that have come in by chat, and we also, I think we have a few folks who will want to participate by phone. So I'm going to turn it back to Renee and have her open up the Q&A portion of the presentation.
Great, thanks, Ken. Thanks for a very informative webinar. As Ken mentioned, after the webinar is over, we will be happy to send you, we'll send you an email and provide a link to a recording of this webinar, and also to a copy of the deck, so that you're welcome to click into the links and have this available for you with all those important deadlines. So as a reminder, as we begin the Q&A section, I do have a number of questions here that folks have submitted. I'll go through those. Please do use the question feature in the control panel if you'd like to ask a question, or if you'd like to ask a live question, please raise your hand and I can go ahead and unmute your line. So let's go ahead and get started with a few questions here. Ken, the first question is, are owners or partners exempt from the $50,000 income average?
Yes, owners and their relatives, and relatives is defined quite liberally by the IRS, are excluded from both the calculation where you add up the hours worked as well as the wage calculation. So relatives are any sibling, brother, aunt, uncle, mother, father, daughter, including in-laws as well. Those are all excluded from the calculation, both when counting up the premiums paid and when counting up the hours worked and average wages. So where this comes into play, it's actually advantageous if you have situations, for example, professional offices, a doctor's office, a dentist office. A lot of times you can have a quite well compensated owner, the dentist or the doctor, and then much lower paid administrative staff. And so we find that professional offices like this are oftentimes good prospects for the tax credit because the owner or the business proprietor is excluded from the calculation in terms of the average wages.
Great. The next question from the audience is the doctor and hospital network in SHOP smaller or the same as outside SHOP?
There are numerous carriers in SHOP, and for the most part, the carriers that are in SHOP have the same network inside SHOP plans as well as outside SHOP plans. The one exception, I believe, Blue Shield has some narrower networks available in SHOP that are not in their outside SHOP plans, except for what they call their mirror plans. But other than that, Kaiser, Health Net, Chinese Community Health Plan, Western Health Advantage, Sharp, all their networks are the same inside and outside shop.
Let's see, the next question is, under the ACA, how many years will the tax credit be available?
That's a great question. So there is no expiration of the tax credit program that we know of. However, for a group or a business owner, they can claim the tax credit for 2 consecutive years, beginning in 2013. So an example, 2014, okay, sorry. So for example, let's say that the business owner claims the credit in 2014, they'd be able to claim the credit again in 2015, and then for that business owner, the tax credit eligibility would be used up. In other words, they wouldn't be available to them anymore following that. The program itself is continuing. It started when the Affordable Care Act passed in 2010 and continues on, and there's been no discussion of discontinuing the program. But for a group can claim the tax credit for 2 consecutive years and then no longer can claim the credit.
Great. Next question is, please clarify when an employee can go to Covered California and get a subsidy for his dependents.
Okay, that's a little off the small business tax credit topic, but that becomes more of a general ACA question. And so an employee can go to Covered California and get a subsidy for his dependents when he's offered unaffordable coverage by his employer, or if he's not offered coverage at all by his employer. And of course, they must meet the income guidelines to get subsidies. If they fall in the 138% to 400% of the federal poverty level for their household income.
The next question is, did you say the insurance premium paid for owners is excluded as well as their income?
Yes, the insurance premium paid that's applied to the credit is for employees only, and employees does not include the owner, and it does not include any of the owner's relatives per that definition. And if you take a look at our tax credit guide for brokers that you can download that I pointed you to, there's more specific information in there that tells you who's considered a relative.
Great. The next question is a bit of a clarification on what you had mentioned about being able to take the tax credit for 2 consecutive years. What if the owner claims the credit every other year? I think I heard you say the word consecutive. Is that correct? Correct.
So starting in 2014, an employer can claim the credit for 2 consecutive years. So an example, let's say the employer claims the credit for the 2014 tax year. They would not be able to skip 2015 and then claim again in 2016. They would need to claim in 2014 and then again in 2015. And then that would be it.
Great. We have our first brave soul who has raised their hand as interested in answering a live question. I'm going to go ahead and unmute her line and ask Mary, if you go ahead and ask your question,
please. I'm sorry, the answer was already given. Thank you.
Okay, thank you very much.
Thank you, Mary.
Okay, I am checking right now. I don't see any more questions. Asking folks, let's see. I do have one other question here. Let's see. Ken, what is the definition of an FTE?
So an FTE is abbreviation for full-time equivalent. And an FTE in IRS speak, for the purposes of the tax credit, is someone who works 2,080 hours in the course of a year. So that's roughly 40 hours per week times 52 weeks. Let's say you have 2 part-timers who work 20 hours per week. That's the equivalent of 1 FTE. So to calculate the FTEs, when we get that payroll data from you or your client, we're looking for the number of hours worked in total for the company. We take that total, and of course, you exclude the owners and relatives from that. So we take that total of hours worked by the company, employees, and then divide it by 2,080, and then we get the total number of FTEs. If it's a fraction, we round down as per the IRS guidelines, and that's how you calculate the number of FTEs.
Great. So Ken, what if the business claimed the small business tax credit prior to 2014? I think this means, are they still able to qualify in 2014?
So let's say the business claimed a tax credit in 1 year, 2012. They can go ahead and claim again in 2014 and then again in 2015. So the rule saying 2 consecutive years, a limit of 2 consecutive years, is not effective until tax year 2014. So they could indeed claim for 3 years if in that scenario.
Great. Next question is, not all my employees are enrolled in the medical plan. Do I count just the enrolled employees?
That's a really good question. A lot of folks think this relates, when you do the counting for the FTE count and the average wage count, they think it relates to just those employees who are currently on, medical coverage or covered by the employer plan. Actually, you're looking at the entire picture of the company, all employees, including employees who no longer work at the company but did during the course of the year. So when you calculate the FTE count, you take into account the hours worked by both past and present employees during the course of that tax year. Doesn't matter whether they're covered or uncovered by employer coverage, whether they're enrolled, whether their dependents are enrolled, none of that matters. It's just strictly who worked for you during the course of the year, how many hours did they work. And the hours are capped at 2080. So if you had somebody who worked a bunch of overtime, you only count 2080. The instructions in our worksheet are pretty clear and pretty easy to follow on that. And of course, we're always here to answer any specific questions that you've got.
Great. This person's client owns a number of businesses and they all file taxes separately. Can they each qualify for the tax credit?
That's a really good question. If any of you have got clients who fall into the quote-unquote large employer category with regard to the Affordable Care Act and the provisions therein, you'll know a little bit about what concept called control groups. And control groups are what the IRS defines as groups that are under common ownership. And when a group is under common ownership and meeting certain requirements, you need to aggregate all of the employees from all of those companies together to determine the employee count and the average wages. So, for example, let's say an individual owns 2 businesses, maybe completely different businesses, and file separate returns. If one individual owns more than 80% of each business, then it's considered a control group, and for the purpose of the tax credit, as well as the large employer provision of ACA, it's considered one company. You need to add it all together, add the employee count and the average wage together for that to determine for the tax credit.
Next question, how does a nonprofit receive the tax credit if they don't pay taxes?
That's actually a very good question. It's kind of counterintuitive. We're not earning, we're not making a profit, so we don't pay taxes. How do we get the credit? The credit is for a nonprofit is actually in the form of a refund, and the refund is based on the Medicare tax withheld by the organization, the nonprofit, both the employer portion and the employee portion, as well as the federal income tax withheld. So let's say, for example, that that organization qualifies for a $10,000 credit, much like the example we showed in the slides. And they've withheld both Medicare and also federal income tax, $7,000 of taxes. They would qualify for $10,000. They would be able to get a refund of those withholdings of $7,000. They wouldn't be able to use the full tax credit, and I don't actually know whether or not they could bank the $3,000 extra and carry it forward. I'm not sure that's possible for nonprofits. That's a question I'd have to do a little more research on. But in any case, the amount is capped by the amount withheld by the tax-exempt organization for Medicare and for federal income taxes.
Great. I just want to let all the attendees know we're down to our last question, so we're honing in on the end here, but I want to encourage you, if anybody has any last questions, please do go ahead and get them in. Thank you for all your robust questions in the questions feature. I'm going to go ahead and ask the last question, which is, are seasonal workers included in the calculation?
Also a very good question. There's a lot of businesses that may qualify for the tax credit that have holiday workers or harvest workers, those kinds of things in agricultural businesses. And there's a really interesting little twist with regard to seasonal workers. So as long as they work less than 120 days during the course of the year, they're not included in the calculation for the number of employees, the number of FTEs, and the average wage. So they're excluded as long as they work less than 120 days during the course of the year. However, if the employer covered them under his plan and paid premium on their behalf while they were employed, the employer is allowed to count that premium in the total calculation of premium paid when factoring in or when calculating the overall tax credit. So the employer gets the benefit of the premium paid towards the seasonal employees, but doesn't get the added FTE count or average wage count in that calculation. So an interesting little twist that the IRS put on it there.
Great, thank you. So that concludes our questions for today. I want to thank Ken very much for your information and presentation. Thanks, Ken. And thank you all for attending today's webinar hosted by Claremont. After today's webinar, as I mentioned, you'll receive an email with a link to watch the recording of this webinar, as well as access the full slide deck and plenty of other resources that we have available to ensure that you can help your clients take advantage of the tax credit.
Renee, I want to thank you very much, and for all the attendees, we really appreciate you joining us today. We hope you found this informational. We're here as a resource for you. Don't hesitate to contact us, and have a great day, and go Giants.